Okay, now let me give you an example. Let's say you own a home and it's worth about $240,000. The balance on your mortgage is $320,000. You've got 7.5% as an interest rate, and your payment is $2,237. You owe $80,000 more than your home is worth. That's called being upside down or underwater. Here is how simple this solution is. You appraise a property and it comes in at $240,000. Your new loan is 97% of that, which is $232,800, and your interest rate is about 5.5%. Now, your FHA upfront mortgage insurance premium is 3% of your loan, which is $69.84. That comes out of your new loan and straight into the FHA's insurance pool to cover future foreclosures. After the customary closing costs, your lender nets proceeds of $221,160 cash liquid now. That is about 92% of the present value of the property. Now, your lender received $98,840 less than the principal balance you owe. So, you execute a silent second worth 50% of your equity, up to $98,840, whichever is less. It is due whenever you sell your home and can be negotiated anytime after 1 year by mutual agreement. There is no foreclosure, no bailout, no subsidized payments, and you stay in your home with reduced principal, reduced interest. Your new payment is $1,363 monthly, a savings of $874, and per year $10,488. Again, no bailout, no subsidized payments, zero cost to the American taxpayer. Some of the benefits are obvious, others are not. So let me go through them right now. For homeowners, 1, they remain in their homes. Number 2, their new mortgage has reduced principal, reduced interest rates currently between 5 and 5.5%, and obviously reduced mortgage payments. Number 3, they don't have to file for bankruptcy to achieve number 2. Number 4, their new mortgage is a no-nonsense 30-year fixed-rate FHA insured mortgage. For lenders, number 1, they will receive their cash liquid now. Number 2, within 30 to 60, maybe 90 days, they will be funding new federally insured mortgages, auto loans, small business loans, student loans, etc. Number 3, it stops the free fall in value of their collateral, the real estate. Number 4, they retain equitable vesting. With a silent second, they can recuperate what is, as of right now, lost negative equity. Number 5, they will attract wayward investors again. Number 6, this will go a long way into passing the stress test. For the financial markets, it restores confidence in our financial markets, namely Wall Street. Now, you may not care about Wall Street, and that's fine, but there are trillions of dollars sitting on the sidelines that should be in the hands of our financial markets and institutions. Now, I know what you're thinking, because I feel like Al Pacino in Son of a Woman myself. I'd like to take a flamethrower to these bankers. But it is important they survive and recover. Let me take a minute here and explain how the markets work. In a healthy economy, a publicly traded company is worth between 15 to 20 times its annual earnings. You can find this number under PE, which is price earnings ratio. They also call it multiple of or times earnings. It's all the same, it's not that complicated. Just don't confuse it for the price of the share. Let me give you a quick example. Say you own a chain of shoe stores and grossed $1 billion this past year. In a healthy economy, your company is worth between $15 and $20 billion. There are two things that drive the market out of this 15 to 20 range. One is it goes above the 20 times its annual earnings, and that is greed. The other is when it goes beneath the 15 times its annual earnings, and that is fear. Just to give you an idea as to how bad confidence is suffering, as of close of business 2/2009, Bank of America closed at 6.89 times its annual earnings. Wells Fargo closed at 4.25 times its annual earnings, and Citigroup closed at 3.61 times its annual earnings. To further illustrate this, Bank of America and Citigroup each received over $40 billion in bailout money. Bank of America is worth $24 billion and Citigroup is worth only 10. That is how low confidence is in these banks and the markets in general. There are trillions of dollars out there, but they're on the sidelines being hoarded by scared investors. Big sissies with no confidence in you or me. This solution benefits our economy, and here's how. Our economy is like this body here. At the extremes, we've got consumer loans and credit cards, small business loans, auto loans, student loans, and miscellaneous. At the heart is our banks. At the heart of the heart are mortgages. When they stop, the body suffers a heart attack. It is now collapsed on the floor, completely lifeless. Like I said in videos I posted back in October, the body doesn't need more blood, which is money. What this body needs is to get the heart pumping again, which means mortgages need to get paid again. This solution is a no-brainer, which is perfect for the Congress. In all seriousness though, we've got this wheel rolling backwards with a shrinking economy, downsizing, layoffs, store closings, bankruptcies, backwards, faster and faster. We need to stop it and get it going forward again. Eventually, it will gain momentum as it feeds itself. Now, this economic crisis began with the subprime mortgage mess and will end by fixing the housing crisis. It affects each and every one of us, including all homeowners, renters, small business owners, the unemployed, students, 401ks, investors, big store chains, even movie stars. Really? Everyone. So please, click more info, type or paste this solution to a letter, email, and fax, and send it to all 3 of your Congress members, as well as President Obama, and then call them. You can find them right here. Regarding the President's housing solution, based on what I heard at his speech February 17th or 18th, I don't remember the exact date, but topic number 1, raising Fannie and Freddie's maximum loan of value from 80% to 105% for refinancing purposes. That's fine, but not necessary if you employ my solution. Topic number 2, incentives for lenders to modify terms of subprime loans at risk of default. Again, these loans were purposely designed to avoid mortgage insurance, and to cover them now is not a viable or responsible financial incentive. Imagine I crash my car into a $100,000 Mercedes. I walk into your insurance office right in front of the accident and tell you I have no insurance and have never paid a premium yet. I ask you to cover my loss and damages. Would you? Would anyone? Topic number 3. Pumping $200 billion to keep interest rates low. I can't argue with that. Topic number 4. Various reforms including change in bankruptcy laws. I agree with the change in laws pertinent to owner-occupants or primary homes, but they wouldn't be necessary if we employ my solution. I'm not clear on the other reforms, but I'd venture to say that they also wouldn't be applicable with my solution in place. Now, I don't mean to criticize, but the President has asked for ideas, and I believe the quickest, least painful, and best solution is one that is uniform and universal without costing the taxpayer $1. I mean not to offend anyone by quoting a parable, but it applies here. The story is a wealthy man gives 3 subordinates some talents, which are units of currency. The first 2 went out and worked their assigned capital and doubled it, which pleased their master. The third hid his currency and preserved it, but did not work it and gained nothing. He was fired. And so that's exactly what's happening here. Everyone is scared and no one is working their capital. Just food for thought.